What if your life savings disappeared before sunrise? Not in a dramatic stock market crash, not in a bank failure flashing across the headlines, but quietly, invisibly, through the slow collapse of a currency. Right now, in Iran, that isn't a hypothetical question. It's a daily reality. On this channel, Macro Rewind, we rewind the world's biggest financial moments to understand what they mean for the future. So if you care about where global money is heading, hit like, subscribe, and stay with me. Because what's happening to the Iranian rial might be a warning signal far bigger than most people realize. The Iranian rial didn't collapse overnight. That's the first myth to break. Currency crises almost never explode in a single moment. They erode slowly, then suddenly. Years ago, the rial was already under pressure from sanctions, declining oil revenues, and government deficits. But what transformed pressure into panic was the loss of trust. Once citizens began to believe their money would be worth less tomorrow, they rushed to spend it today. That's when inflation stops being a statistic and becomes a psychological chain reaction. Walk through a market in Tehran today, and you see the real story of inflation. Prices rewritten weekly, sometimes daily. Shopkeepers refusing to quote long-term prices. Families converting paychecks into gold or dollars as soon as they arrive. And when a currency stops acting like a store of value, people stop treating it like money. It becomes something to escape, not something to hold. That shift is the moment inflation turns into something far more dangerous. The numbers tell the same story. Over the past decade, the rial has lost massive portions of its value against the dollar. While inflation has fluctuated year to year, the long-term direction is clear. Purchasing power has eroded relentlessly. And that erosion doesn't just hurt investors or traders. It hits wages, savings, pensions, and the cost of basic necessities. Inflation is never abstract. It shows up at the grocery store, at the gas pump, and on the rent bill. But here's where the story becomes global. Because the forces behind Iran's currency collapse aren't unique. They're structural. Governments spending more than they earn, and the central banks printing money to cover deficits. External shocks hitting fragile economies. These aren't just Iranian problems. They're patterns seen throughout financial history. And every time they appear together, the outcome tends to rhyme.
To understand that pattern,
Rewind to the Weimar Republic. In the early 1920s, Germany's currency collapsed so violently that workers were paid twice a day just to spend wages before prices rose again. Savings were wiped out. Social stability cracked. It didn't start with hyperinflation. It started with debt, money creation, and declining confidence. The final explosion was just the last chapter. Fast forward decades, and you see similar echoes in Zimbabwe, where money printing to fund deficits destroyed the currency, and later in Venezuela, where inflation spiraled into one of the worst economic collapses in modern history. Each case had its own political story, its own triggers, its own timeline. But the mechanics were strikingly similar. Too much currency chasing too few goods, paired with a public that stopped believing stability would return. Now, the question hanging over the global economy is whether those same mechanics could appear elsewhere. Not necessarily tomorrow, not necessarily in the same dramatic fashion, but gradually, quietly, in ways that many people might not notice until it's too late, because inflation doesn't announce itself with sirens. Look at the modern world's financial system. Since the global financial crisis, and especially after the pandemic, governments around the world dramatically increased spending. Central banks injected unprecedented liquidity. Balance sheets expanded to levels that would have seemed impossible decades ago. In the short term, those policies prevented collapse. But in the long term, they introduced a new risk. The possibility that the value of money itself could be questioned. The difference, of course, is that major economies issue reserve currencies. The US dollar. Backed by the credibility of the Federal Reserve and the scale of the United States economy, isn't comparable to the rial. It benefits from global demand, deep financial markets, and institutional trust. That trust acts like armor against sudden currency collapse. But even armor can weaken if confidence erodes slowly enough. History shows that inflation rarely destroys strong currencies overnight. Instead, it chips away at purchasing power over years. A few percent each year doesn't sound dramatic, but compounded over a decade, it reshapes wealth distribution. Savers lose, asset owners gain. And inequality widens. creating social pressure that feeds back into political decisions about spending and monetary policy. That's where Iran's situation becomes a kind of stress test for global money. It shows what happens when confidence fully breaks. When citizens stop believing that policymakers can stabilize the currency, they create their own escape routes. Dollars under mattresses, gold jewelry as savings. Real estate as protection. The local currency becomes a temporary tool, not a long-term asset. And here's the uncomfortable truth. Even in stable economies, people are quietly making similar moves. The explosion of interest in commodities, real estate, cryptocurrencies, and inflation hedges isn't random. It reflects a growing awareness that money itself isn't guaranteed to hold value forever. The Iranian case just pushes that awareness to its extreme conclusion. The International Monetary Fund, has repeatedly warned that prolonged fiscal imbalances combined with weak institutions can trigger currency crises. The formula isn't mysterious. Persistent deficits require financing. Financing often means money creation or debt expansion. And if growth doesn't keep pace, inflation fills the gap. Eventually, markets or citizens push back. What makes today's global environment unusual is how many countries are running large deficits simultaneously. Levels across developed economies are near historical highs. Central banks face a delicate balance between controlling inflation and supporting growth. And geopolitical tensions continue to disrupt supply chains, energy markets, and trade routes. Each of these factors alone might be manageable. Together, they create a fragile equilibrium. But fragility doesn't equal inevitability. Hyperinflation remains rare, especially in advanced economies. Institutions, independent central banks, and global demand for reserve currencies still provide powerful safeguards. The lesson from Iran isn't that hyperinflation is imminent everywhere. It's that the path to currency instability always begins with small, rational decisions that compound over time. For ordinary people, the real takeaway isn't panic, it's awareness. Inflation doesn't have to reach extreme levels to reshape financial lives. Even moderate inflation changes how savings work, how investments perform, and how long-term planning must be done. Understanding that dynamic is the difference between reacting too late and adapting early. That's why stories like the rial's collapse matter. They reveal the end of a process most people never watch from the beginning. By the time hyperinflation makes headlines, the structural causes have been building for years. Watching those causes unfold in real time in one country helps us recognize the early signals elsewhere. And those signals aren't just economic, they're behavioral. When citizens rush to convert currency into hard assets, when long-term pricing disappears, when trust in official statistics fades, those are the real warning signs. Numbers follow psychology, not the other way around. The question isn't whether the world will see another hyperinflation crisis somewhere. History suggests it will eventually. The real question is where, when, and under what conditions. The Iranian rial offers one possible roadmap. But it also offers a reminder. Currency stability isn't just about economics. It's about trust, governance, and credibility. That brings us back to you. Because currency crises don't start in markets. They start in expectations. When enough people believe tomorrow's money will buy less, they act today, and that action makes the belief real. Inflation is one of the few economic forces that becomes self-fulfilling. So what does the rial crash really reveal about global money chaos? Not that collapse is guaranteed. It's not that every country is doomed. But that money's value ultimately rests on confidence. And confidence is more fragile than most people assume. If you found this breakdown useful, drop a comment and tell me where you think the biggest inflation risks are forming right now, and share this video with someone who still believes currency stability is automatic. Because the biggest financial shifts don't start with explosions, they start with quiet cracks. And by the time everyone hears them, the system has already begun to move.